Hi, I'm Phil Thompson. Thanks for joining me for Phil's Finance Fix. Today I'm going to be talking about borrowing to invest in shares. So borrowing to invest is often called gearing or leveraging, and most people understand the concept of borrowing to invest in a property, as it's pretty much impossible for most Australians to buy property with cash. However, borrowing to invest in shares is a little bit different because most people can afford to buy at least one share. For example, the most expensive share in Australia's top 200 company at the moment is $95, and the average share price of the top 100 companies in Australia is only $16 per share. So this begs the question, why do people borrow to invest in shares when they can just purchase the shares from their money that they've saved up? So basically, the idea behind leveraging your own cash and using borrowed funds is the aim to get a greater return on your investment with either property or shares. For example, if you put two scenarios side by side, scenario one, we're just investing $20,000 of cash, and the scenario two, we're investing $20,000 of cash and also borrowing $20,000. So that's a total $40,000 into a share portfolio over a 10-year period using the assumptions that we've written right here. Then it can be seen that the strategy, which with the investment loan, can lead to higher profits before capital gains tax. So after 10 years, the borrowed funds strategy had a gain of $35,766 compared to $22,763 for the strategy that only used cash to purchase the investments. As you can see, borrowing to invest is not just to buy an asset that's virtually impossible to buy with cash. It can be a really good long-term wealth creation plan. However, borrowing to invest in either property or shares is definitely not for everyone. And though borrowing to invest can multiply investment returns when property or share markets are doing good, it can, however, multiply your investment losses when the markets fall. So there are many different risks that you need to be aware of and also manage. And some of the risks are changes to legislation. So the government may make changes to negative gearing, which can impact on the benefit. Making sure that you're not borrowing too much and therefore increasing the risk. Also diversifying your assets, such as not just buying one lump sum of one stock or one managed fund. Make sure you're spreading it across a few different stocks or asset classes. Not relying solely on the income from the investments if you're borrowing, and understanding that you may not get the income that you're requiring. And also understanding the loan type. So are you using a loan that has the ability to sell your assets or ask you to contribute more cash, or are you borrowing against your property? Thanks heaps for watching, and if you have ever thought about investing into shares but just had no idea where to start, or if you've just got a few questions, please just shoot me an email, phil@thompsonfs.com.au, because I'd love to help you out. And if you do enjoy these videos, we put up a different video every single week on different finance topics, and I'd love you to subscribe to the channel as it really helps us out. Thanks again, and I'll see you next week.